As we wait for the Swiss National Bank to decide next month between zero and negative interest rates, the head of the SNB late yesterday had a lot to say. Negative CPIs, the status of Treasury securities, companies pulling deals, what the Swiss see for the global economy, which is what all the Switzerland stuff is really about. SNB Chief Martin Schlegel, though, he wasn't the only one issuing cautionary statements. JP Morgan's chief, Jamie Dimon, was even more blunt with his. In fact, Dimon's comments on complacency and, more importantly, credit risks, they preface everything that Schlegel had said, providing a perfect setup for the global framework, creating these headaches in Bern and Zurich. And those headaches have shown up again in global repo. We have an update from the Treasury Department on American banks bailing out the world heading into the April liquidations. In other words, everything that Schlegel was talking about had already bubbled up in repo in February and March. In fact, total tracked resales in the first quarter soared by more than $300 billion, nearly 20%. That's a lot of deflationary potential in the global monetary system, which already raises the chances for more of it, which then might send the Swiss franc soaring even higher, Swiss consumer prices even more negative, and Jamie Dimon's caution right back into the stock market. But with Dimon specifically, it wasn't just what he said. In fact, JP Morgan, the bank, raised its loan loss reserves by 3 times the amount that analysts were expecting for the quarter. What is it that unites all of these things? That would be the fact that trade wars didn't break the economy, didn't raise all of these risks, and therefore trade delays and maybe even some deals are not going to fix it. As I said, what Dimon and JP Morgan were doing, what Dimon was talking about and JP Morgan actually did, is the perfect preface and setup for the comments from Martin Schlegel and the SNB, because all of these things are tied together, globally synchronized. What Dimon said at a conference, in fact, it was the Investors' Day at JP Morgan, he said, quote, "Credit today is a bad risk. The people who haven't been through a major downturn are missing the point about what can happen in credit." In fact, for JP Morgan, they're not waiting around to find out. The bank had set aside $973 million to the pile of assets that it uses to cover bad loans. In other words, loan loss reserves, when analysts were only expecting around $290 million. These are not catastrophic figures, but it shows exactly what the bank is thinking and which way it's leaning as far as macroeconomic risks before we even get to the fallout from trade wars and everything else that goes along with it. The payback period in the macroeconomy that was in bad shape and fragile shape before we ever got to April. But back to Dimon. People feel pretty good because you haven't seen an effect of tariffs. The market, he's talking about the stock market, came down 10%, but it's back up 10%. I think that's an extraordinary amount of complacency. And remember, we pointed out before, back in February, how high complacency had been in the credit markets before the events that erupted afterward. And the complacency is always about convincing and rationalizing away risks that continue to get more and more apparent, not less. But the theory that has the entire marketplace, the risky parts of the markets, junk credit as well as stocks, the theory that has them re-risking is this idea that it's all about the trade wars. And if your perspective is solely from the stock market, it seems like that's a legitimate case, because the stock market seemed to be soaring right along until the middle of February. Then all of a sudden from the middle of February, stocks plunge, and then they turn right around when the Trump administration announces a 90-day delay to tariffs on April 9th. So it seems like this is entirely about trade wars, and therefore trade delays and eventually deals will save us all from any of the negative consequences. But that's what we keep saying, we keep pointing out, and even Jamie Dimon agrees, there's a lot more to it. The situation was far more fragile before we even got to April, even before we got to 2025, and therefore the potential for credit cycles and credit risks are far higher than complacent risk markets would like to believe it is. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store of value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. There are much bigger problems that are now coming to a head, and at most, trade wars are giving some of these stresses some urgency they didn't have before, but should have. And then they haven't gone away. That's really the point. Dimon stressed it, and so did Martin Schlegel, the head of the Swiss National Bank, in his own way. Speaking yesterday at a conference, he had quite a lot to say. First of all, he said, for this year, inflation in certain months can be negative. We always focus on the medium term, which means that in the short run, inflation can also be below 0 or above 2%. I love how he throws that above 2% in there as if that's sort of a risk. What he's really doing is downplaying the fact that the Swiss are likely to experience negative CPI prints over the months ahead. In fact, the CPI was already 0 in April to begin with. He's trying to prepare the marketplace for that increasing possibility to the point that it's actually likely. So he's trying to downplay its significance by saying, it's no big deal, we're not going to react to it, when we already know that he already did. The entire reason why the Swiss National Bank cut by 50 basis points in December was to make sure that something like this didn't happen. So he's already somewhat throwing in the towel on those rate cuts and the ability to hold back the deflation in consumer prices. He was speaking at the University of Lucerne, and then he added, the inflation outlook is very uncertain. That's uncertainty stemming from tariffs is particularly large. And what's really happening here is the Swiss National Bank, like a lot of central banks around the world, they're using tariff quote-unquote uncertainty to cover for missing the degree of weakness that's been developing really since last year. And most of all, they're using tariffs as cover for how rate cuts didn't lead to the outcomes that they all promised. The Swiss National Bank in December, when it cut by 50, specifically stated this will keep Switzerland and consumer prices in Switzerland from turning negative. And now the Swiss National Bank at its head here in May is saying, well, we're likely to see negative months anyway, but we're going to blame this on tariffs rather than a fragile economy. But we know it's a fragile economy because the S&P started cutting rates last March. They were the first one to warn about the global economy, globally synchronizing economy, that had absolutely nothing to do with trade wars. And they kept seeing consumer price rates sink more and more than they expected, and they kept cutting rates like we expected, chasing weakness in the Swiss economy that was coming in from around the rest of the world. All the Switzerland stuff relates to the globally synchronized economy. So now the next step for the Swiss National Bank is they're meeting on June 19th, and it's almost a lock for the S&P to pull its benchmark rates back down to 0. And there is a substantial chance, which is what Martin Schlegel was talking about, the S&P actually goes negative. In fact, he reiterated the central bank's position is if the currency gets to be too strong, and the reason it gets to be too strong is because of the difficulties we're going to talk about in the global system in just a moment. If the franc gets to be too strong, he reiterated yesterday, they will not be afraid to turn negative rates in Switzerland all over again. And that's a possibility that seemed to be impossible around a year ago. Everybody was talking about higher for longer inflation risk. And here's the Swiss National Bank talking in May of 2025 about a very high chance, negative CPIs, negative rates, and all of it driven by globally synchronized weakness. Talking specifically about the Swiss economic situation, Schlegel also said, we expect that Swiss growth this year will be lower than expected just a few weeks ago. So they're already downgrading their own economic forecast in the short run because it wasn't trade wars that actually broke everything. In fact, Schlegel added, we see a postponement of investments, which he wants to blame on trade wars, but it's really about the fragile economy that's been moving in this direction all the time. Trade wars might have lit a fire under all of these negative pressures, but they didn't put them there to begin with. And echoing Jamie Dimon's comments on risks, the The Swiss franc is still hanging around its high levels. Remember, back on April 21st, I did a video on this. The franc hit a 2011, the highest exchange value it had seen since 2011, just above 0.81 to the US dollar. Since then, it had backed off, falling to around 0.845, 846 to the US dollar by the middle of May, May 12th. But over the last week or so, the franc has been starting to strengthen all over again as the marketplace begins to digest how this risk market, stock market euphoria, a lot of it is misplaced. As Dimon was saying, there's too much complacency, and that the real risks to the global economy and the monetary system, as we'll see in a second, aren't going away so easily. So the Swiss franc didn't really rebound all that much from its extreme level, and now moving back in the other direction, which is consistent with all these other signals I've been talking about, whether it be swap spreads or copper to gold, all of them signaling that the situation hasn't really shifted in any meaningful way since early April. The risks are still there to the economy, and therefore they're also there for everything else beside, including consumer prices as well as financial conditions, meaning the franc, and of course the monetary system, which drives the franc and everything else in its path. But commenting on U.S. Treasury specifically after Moody's downgrade late Friday, what I talked about in yesterday's video, Schlegel finished up by saying U.S. Treasuries are very liquid. There is currently no alternative to them, and it's not foreseeable that there will be an alternative. And that's really the problem. We wish that Treasury securities weren't the primary form of collateral, nor the financial asset that had the deepest market to it, but that's the world we have, not the world that we want. And there really is no alternative to this, so we're kind of stuck with it, which is what Schlegel was saying. And actually, his comments were echoed by the head of Singapore's monetary authority, who said basically the same thing. Speaking in Qatar, I'm going to call it Qatar, people call it Qatar, that just sounds weird. Speaking in Qatar, chimed said they are the dominant safe assets for use in the financial system, talking about U.S. Treasuries, that are deeply embedded. The $28 trillion Treasury market is fundamental and systemic to the global financial system, and there is no alternative for this point. In other words, we're stuck. We are really stuck with the Eurodollar system and how the Eurodollar system operates, and how the Eurodollar system depends substantially on Treasury securities, and more so, not just the amount of Treasury securities, but really the flow of Treasury securities, the circulation, something that I just talked about in a new video at Eurodollar University's member section. Why is collateral so important, and why is collateral flow the key ingredient to monetary health and monetary elasticity? So what the head of the Singapore Monetary Authority said, same thing as Swiss National Bank Authority said, was essentially, we're stuck with treasuries, we're stuck with the Eurodollar system, there is really no alternative to it, so we have to deal with all the consequences and fallout, which shows up far too often and far too frequently. And a big part of those problems, they're deflationary. And what deflation means is that there's an interruption in the free flow of money and credit through the system, largely because the banks that are responsible for circulating and recirculating and hypothecating credit and collateral, they are impaired in some way, usually because they become risk averse. Not regulations, not government policies, but as they become more and more risk averse, they pull back more and more on their balance sheet capacities, which restricts the free flow of money, credit, and collateral, therefore leads to deflationary outcomes and consequences in the financial system. And if we're not lucky, it becomes the same thing in the real economy too. The type of things that the Swiss National Bank are talking about and crafting their interest rate policies to try to deal with, that they're just simply not effective, because this is far beyond the capabilities of any central bank to do anything much about except just be along for the ride. The latest statistics we got from the Treasury Department, its Treasury International Capital Report, or TIC, showed that there was an uptick in resale activity in March heading into the liquidations in April. And that added to substantial uptick in resale activity in January and February. Now, I covered this before about a month ago in a video about what resales are and what they mean, and why there's such a strong correlation between resales and U.S. Treasury nominal yields. But just the brief summary here is that a resale is just repo from the opposite perspective. If a repo is a repurchase agreement, it's an agreement to sell a bond and receive cash. repurchasing the bond later with that cash plus interest, really just a collateralized loan from the cash borrower perspective. The resale is just the other side of that. It's the agreement to buy a bond today with the cash that you have, and then agreeing to sell it back later with the same cash plus some interest. So the collateralized lender in this case, or in many cases, we have to keep in mind that the cash lender is also the collateral borrower, and the cash borrower is also a collateral lender. So in many ways, repo doesn't just circulate cash. It also, in many ways, it often intends to circulate collateral through the system as well. So a resale is the cash lender, and since the tick data takes the perspective of U.S. banks, when they're lending cash outside of the country in the repo market, it is for them a resale, or some people call it reverse repo, but for some reason tick classifies this as a resale. What you see in the tick data over more recent time, I went through the entire history of resales and the relationship with the Treasury yields in that previous video, but more recently, resale activity corresponds pretty strongly with the bond rally that began in October 2023. In fact, you see a pretty sharp increase in resales, around $100 billion between October 2023 and January 2024, and another pretty sharp increase, a little bit over $100 billion between June of 2024 and August of 2024, so July and August, the 2 months of the carry trade blow up. Huge increase in resales, therefore U.S. banks lending on a secured basis outside the country. And then you had an artificial high. By December, resale volumes were back down to 1.58 trillion. But from there, in the first quarter of this year, it's been completely insane, as you would expect, given the conditions that we've seen erupt in the financial system around the world. Resales have absolutely soared. They increased by a huge, almost 200 billion, 180 billion in January. Another big increase in February, and the latest data that we just got for March puts it at just shy of 1.9 trillion. That's an increase of 315 billion just in the first quarter, or roughly 20%. And since we see resale activity increase when there's monetary difficulties evident around the rest of the world, like I said, not only does it fit with these conditions, it also fundamentally leads to why Treasury yields end up going lower. Because when U.S. banks are lending a lot more cash to outside the United States on a collateralized basis to these offshore counterparties, they're doing this in periods of monetary tightness as sort of the lender of last resort, the real lender of last resort. In other words, conditions that are overall deflationary, just like we saw developing, especially from the middle of February into March and right on into April. That's what caught up the stock market. It wasn't tariffs and trade wars that were the full thing. It was tariffs and trade wars that created the sense of urgency for the fragile economy, leading to this deflationary breakout. And so that means, in one sense, more demand for collateral overall to access this resale funds that are becoming the lender of last resort. So specifically demand for U.S. Treasuries, since in a lot of these deflationary periods, some of the junkier forms of collateral become less and less acceptable. That was the increase in credit spreads that we saw, and this is the other side of that. And of course, those deflationary conditions in the monetary system mean down the road a drag on real economy, consequences of lower growth and less inflation, and maybe even deflationary outbreaks like the Swiss National Bank was talking about in its own local Swiss economy as far as consumer prices. These are basically the fundamentals of interest rates expressed in the global repo market, and the global repo market difficulties. So Treasury yields that are determined by these fundamentals, growth and inflation expectations, you would expect them to be falling at the same time we see resale activity rising because of what both represent. What the resale activity represents is the monetary system's breakdown and the risk aversion that's driving it, and then the consequences over the longer term expressed in lower yields as lower growth and lower inflation. And sure enough, what were Treasury yields doing in March as resales continued to rise? Treasury yields were also falling pretty sharply. So you can, I hope, see how all of these things tie together. Not just that they're drawn from globally synchronized factors, but also it's not just talk like you normally hear from central bankers like Jay Powell. Jamie Dimon says, hey, we should be careful about the credit cycle. Maybe there's too much complacency. At the same time, JP Morgan raises its loan loss reserves far more than analysts were expecting. The Swiss National Bank Schlegel, he's saying, yeah, we might need to be prepared for negative consumer prices in Switzerland as a reflection of global economic weakness, and we're ready to go with negative rates if we have to, implying that we're likely to do so, getting everyone ready for that fact. And of course, the repo market, fragile, bad shape to begin with long before we got to 2025 and tariffs. But then the tariffs come along and amplify the negative pressures enough that we see the fragility, we see those cracks. None of those things are fixed or shifted by trade delays. It wasn't the trade wars that broke it, so it's not going to be trade deals that fix it. And that's what all of these things together are warning about. Here in the middle of May, we didn't escape everything in April. It's still ongoing. There really is a whole lot more to the story linking resales to nominal treasury yields. And as I said, I went over that in a video about a month ago. That's the one I've got linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.